Just a quick disclaimer before starting the webinar that whatever the stock ideas that we'll be discussing today, so it is just for the information purpose. And do reach out to your financial advisor or do your own research before investing in those ideas. So just to set the agenda for today's discussion, so basically I'll be taking you through our tactical opportunity which has presented itself. And then I'll also be discussing about why small caps make sense to be a part of the investor portfolio now. And my colleague Vijay will be then discussing about our super value aggressive scheme that we have recently launched and some of the key themes we are really bullish about, right? So starting with, Prabhu, if you can move to the next slide, please. Yeah. So we have done a study of last 15 years of data, right? And we have tried to find out that what should be the ideal return expectation from time to time from different sub asset classes or categories that are there in the market, right? So mainly if you look at the 3-year rolling return data of the large caps, mid caps and small caps, so the returns will look more or less similar when it comes to the rolling return basis. So the returns are in the range of 11 to 12% for the large caps, mid caps and small caps. But if you look at the actual distribution of those returns, right, that plays a very important role in identifying the return expectation from the each of the subcategories, right? So if you look at the distribution of those returns, like the big black columns in the middle of the figure, right, the returns are mostly in the line of 10 to 15% for the large caps. It means that if somebody has a fair risk appetite and wants to have a fair degree of certainty on the return, on the 10 to 15% side, so then that investor should go for the large caps. Similarly, if some investor has a slightly higher risk appetite and slightly higher return orientation, so and is looking to make and is looking to generate a return of 18 to 20% for the portfolio, so then we have towards the right hand side, slightly right hand side, we have these big green columns which is for the mid caps. So these mid cap segment present a very ideal opportunity for the investors to invest on a 3-year basis and reach at the desired return expectation. Similarly, if somebody is looking for very outside return from the market, and actually investors, fund managers from the small and small cap space have delivered returns in excess of 25%, right? So if somebody is targeting those returns, returns in excess of 25%, so we have these red columns in the right side of the distribution where we can see the returns of 28, 30 and 33% also. But that comes with a caveat that none of the other categories like large cap and mid caps have given a drawdown of more than 10% on a 3-year basis, right? So it's the only category where we have seen the drawdowns more than 10%, like, the 3-year return being minus 18% CAGR. But if we are right in entering into the market, right, and if we have all the checklist done, like, what should be the valuation, what should be the entry point, what should be the liquidity environment, right, all those things taken care of, the good earnings growth for the portfolio is also accountable for. So then the positive return could be something that could be easily achieved by the investors if they are entering at the right time on the small cap side. So this was the general perspective, like, how one can tactically look to allocate the portfolio across the large caps, mid caps and small caps. Now moving on, if we look at the calendar year wise returns, so we have looked at the year-on-year returns for different categories, right? And if you look at the large caps, it has been a very it has been a category where we have seen outperformance only in the years when broader market was beaten down, right? Or in the years when the money flow was very concentrated to the select large caps name in the market. For example, in the years like 2009, 2012, right, 2020, when it was a year of weak sentiment for the equity market, the large caps have outperformed, nevertheless with the negative returns. And the years in which it has given positive returns and have outperformed, like FY11, FY13 and 19, so that years the money flow was into selective large cap names, right? And again, these returns were not something very outside returns, right? These were very average returns for the investors. Similarly, if an investor is looking to allocate for long term, like he wants to make the money in the market for long term and be invested, so mid cap is one of the best categories to be invested, right? The returns from the mid caps, it will not be the best in the category, but again it will be higher than the mid caps. It would be higher than the large caps, and again the variability of those returns will be lower, right? So typically mid caps will never be the best performing category, never will be, very few times it will be the worst performing category, but again on an average it will give you a very good CAGR return on the overall portfolio, right? So for long term investments, people who wants to invest for 5 years, 10 years, 7 years, so mid cap is one of the category that should be actively looked at and be allocated for. And if you look at the small caps, the return distribution, So the returns have been very skewedly distributed for the small caps, right? So 1 year it will give you a very humongous return. Next year it will this category, or after 2-3 years, it will give you a return which is down 20% from the peak or 25% from the peak. For example, in the year of 2010 or 2012, 2010 and 2015, the returns made by the small caps is almost double than the large caps, right? 160% return, 54% return. But again, it has also given you sharp declines in the month of years of 2019 and 2020. So a small cap is a space where you have to be very tactical about, right? You can't just stay invested in this category and expect that the outperformance of previous year will also be followed for the next year. So it's a category where you have to be you once you make your money, you have to book your profits either partially or fully, and you have to exit out of it, right? So it's a category where the category will start picking up in a year, then it will peak some bit in the next year, and then finally third or fourth year it will there will be a lot of euphoria in the market, in the broader market, and that's the time for the investor to book their holdings and get out of it, right? The investors who remain invested in those stocks, those names, so when the cycle turns and the liquidity crunch will happen in the market, so actually the investor will lose some bit of the upside profit which they have generated. So they have to be very tactical when they're investing in the small cap. So just to summarize, for safe investors looking for moderate returns, large cap to be the place. For investors who want to do a long-term investment and looking for outside returns, mid cap is the place. For slightly higher return in the market, and being very tactical and looking to chase higher returns, so the small cap space to be the place, right? So just to look at another angle from the for the market, right? If you look at the FIA flows over the years that we have seen, so we have again gathered the data for last 15-18 years, and we have seen how different categories have behaved with the FIA flows. So last year was a year in which we have seen around 1.1 lakh crore of FIA outflows happening from the market, and that has actually greatly depressed the returns for most of the categories. And this has been historically also, this has been same. But what we have seen that the years in which FIA put the money and the follow-on year, the equity market remains buoyant, but the small cap is the segment where we see most of the returns coming for the investors, right? So now from current standpoint, right, we have to analyze the factors so FIIs, when they invest in the emerging market, they look for two sort of returns. The first is obviously the domestic equity return that or foreign equity return that they will be getting from the market, and the other thing would also be the currency appreciation. So in an environment when the rate hike is happening, and there is a whole sort of rush towards safety, right? The economic scenario is weak. The global backdrop is kind of very mild. So in those times, the FIA prefer to take money out of the country because the dollar returns or the currency return will be negative for them. So, and now that we have seen all those things happening in the last year, so from current standpoint, we feel that now that we are entering into a rate cut trajectory, maybe and again we have seen the dollar index coming down from a high of 114 to around 110. So it will give a dollar currency appreciation for a lot of FI investors. So going forward, when the rate cut will happen, it will create a liquidity situation scenario for a lot of emerging markets. And also, if you couple that with the growth prospect that we have, right? So we have the growth was never a problem for the domestic market, at least for the Indian markets. But now that if we couple that with good foreign flows, so we see that the liquidity will play a very important role. And from here on, the small cap is one of the segments which will be getting impacted hugely, right? And we see that maybe next 2 to 3 years, we'll see a cumulative inflow happening close to 2 lakh crore of rupees in the Indian markets that will actually first come to the large caps, then to the mid caps, and finally to the small caps. But the return that one can generate from the small caps will be way higher than the return can be generated in the mid caps and the large caps. Now moving on, just to have a close look at what was the landscape for the FY 2022 and 23. So if you look at, there are a few factors, right, which has impacted the market last year. For example, inflation was around 8, 9, 10% for a lot of economies, right, which has now moderated to 5%, 6%. And if you look at the peak of the inflation that the economies has made, maybe in September of last year, until now in the last 7, 8 months, 8, 9 months, the cumulative inflation is in fact lower than the 3%. So we think that inflation is no longer have a role to play in the markets. And the interest rate, which was again peaking out last year, has actually plateaued, and the in-house view on the inflation is that will not be seeing the interest rate is that will not be seeing any further interest rate hike. Maybe by the end of this year or early next year, we'll see an interest rate cut happening in the economy. The recession expectation, which was very buoyant last year and which was very strong, we feel that we are going for a soft landing, and we'll see some slowdown happening. But wider slowdown is not a case that we have to factor in our models now, and we see that the recession is not no longer a problem for the developed markets, and we will not be facing any headwind from that part in the domestic market as well. Now, dollar index, which was close to 114, has actually come down to 100 level, and we feel that since as and when we'll be entering into the rate cut cycle, the dollar index will stand to correct more, and it will average around 90 for this year and next year, and that will again be a trigger for more money to come to the emerging markets, especially to the Indian market. The crude, which was again hit a peak of last year 130, has moderated now to $70 per barrel level, and even with persistent output cut, we are not seeing much fluctuation happening in the Brent crude prices. So it means that the actual demand and supply level is at match, is kind of balancing out. And last year, what we saw was the spike on the speculation of the dollar price, right? And it was not the trigger for the actual supply and demand. It was just a speculation because which the crude rallied. But now it has more or less balanced out. So we don't see this as a problem anymore going forward. Now, global equities, across the geographies like US, Europe, China. So all the geographies have their own problems, right? And now we are when we are entering into the 2023, so we see that FTSE has already hit a all-time high. Hang Seng has already recovered from the lows of November, right? And it has well ahead 20-30% from the bottom. And in fact, Nasdaq is also rebounded and around 25% up from the bottoms. So we see that the mood for the global equities is kind of positive, and that will also rub off well for the domestic equity market, where we have a kind of volatile last year. But going forward in the 2023 and 24, so the market has already reached to the all-time high levels, and from here on we can see a good upside for the domestic market as well. So whatever the triggers for the market to be volatile in the last year, the triggers have reversed, and actually they have turned into the tailwinds, and we'll see the positives coming to the market very soon. So now, just to focus on why we are very much bullish about the small and mid caps. So just to give a broader sense, how the different categories are categorized. So mainly the if you look at the market cap by Sebi, so 46,000 crore and odd is the large caps. Between 16,000 to 46,000 crore is the mid caps, and from 500 to 16,000 crore is the small caps, right? So our sweet spot is to identify for the companies which fall in the range of 500 to 20,000 crore market cap. Now, this market caps gives us a lot of opportunity in terms of identifying new industries which are not widely covered. Go for the companies which are which are market leaders in their own small segment. But nevertheless, because of the innovation being done by those companies, the market itself is expanding and the company is also growing. Plus, these companies have healthy return ratios, which can also augment the return for the investors. So this is a space we are very comfortable for, and we feel that as a fund manager and as a portfolio manager, we add a lot of value identifying those gems for our investors. And that's why we are very much bullish about this space also, especially on the small caps. Just on the small cap side, going forward, if you look at the return distribution for the last 15 years, Prabhu, if you can move to the next slide, please. If you look at the last 15-year returns, bearing 1 year of 2008, when there was a global financial crisis, when the market was down close to, for the small caps, close to 60-70%, if you have invested in the small caps, there is a 70% probability that you stand to make money, positive return investing in the small caps. But we are not focused on making positive returns. We are focused on making the outside returns in the market at today's point of time. So if you look at the distribution of returns, right? So there is a 50% times the small caps have given a return of more than 25%, and that has been a very unique category in itself, which has at 50% of the times has given a return more than 25%. So you just have to be very tactically right about when to allocate into the small caps and when to come out of it. If you be invested, then you will see the drawdowns also of 10, 15, 20%. But if you just be entering at a time when the bear market is bottoming out, and we are at the onset of a next bull market. So the chances are that you will be clocking in the returns higher than the average return of 20% is very high for that space. Now, looking at the space, 2000 odd companies from the small cap side. So if you look at probably, please, yeah, if you look at the overall distribution of returns, right, in the small cap space, so the bottom quartile of bottom 500 companies is like, where you hardly make any money, right? In fact, if you invested in those companies, you stand to lose the wealth that you have invested in those companies. But if you focus on the top 500 companies, the 10-year CAGR of those 500 companies, the return of those 500 companies from the small cap side is close to 37%. So we are very much focused on building a portfolio of 25 odd companies where we handpick from a small pool of 500 odd companies, right? So the entire universe of a small cap is it doesn't have a lot of meaning for us. Rather, we have to apply such filters and look for the businesses which can withstand the test of time and the volatilities of business cycle, and then stand to deliver superior returns for the investors. So the takeaway is that overall BSA small cap has actually given a return of 16%. But if you can find out some selected stocks from that entire segment, so the return could be very much well above the average, and it's close to around 37% or percent for the top quartile. Now, moving ahead, if you look at the valuations for the small cap segment, right? So if you look at the valuation for the large caps and the mid caps, the valuation are in range to the long-term averages, and in fact, slightly higher in the last 2 months. But if you look at the small caps, so after adjusting for the peaks and all, in fact, adjusting for the peaks and all, so the long-term average for the small caps is close to 20. And in fact, if you look at the current valuation, which gives us a lot of comfort that the small cap is trading close to 15 or 16p, which is around 24% discount to the long-term averages. So we have seen an 18 months of down cycle where the markets have not moved much. The small caps is actually declined from their peak around 17, 18%, 20%. And then we have seen the compounding of earnings happening in the small caps, right? So around 15 to 18% of the earnings have compounded, in fact, in the weaker market as well. So on and whole, we see that the opportunity itself is of around 48% or 48% discount from the fair value. So when the liquidity scenario will present itself, right? For example, when we get into a rate cut cycle, when the consumption boom will happen, right? Or when we'll see the inflows coming from the foreign market, so that will present a very good case for this small cap companies to catch up to their true potential, and we'll see the returns expanding then and there. So just to move on and see the cycle of last 20 years in the small caps, and this is the actually thesis for our launch of super value aggressive scheme. So if you look at the last 20 years data, we have seen around 4 or 5 peaks in the small caps. So small caps behave in a cyclical manner, right? So there are times when the small caps will do very well. There are times when small caps will actually be brutally beaten down. But if you look at the past peaks, so past peaks were made in 2006, 2008, 10, 18, and 22. So those are the years where the index expanded handsomely and it has generated good returns. But if you look at the fall from the peak also, so that average around 79%, 54%, 56%. So we've seen those upward drawdowns as well. But we have to be very prudent in investing and exiting from the market, right? So the average decline from the peak for the small caps is close to 45%. Average gain from the bottom, and right now we are at the bottom of the small cap cycle. So the average gains from the bottom is around 220%, and the cycle ranges from 24 to 32 months. So we have seen 18 months of down cycle for the small caps. Now we are coming out of it with all the positive tailwinds, and that's why we have come up with the RH Super Value Aggressive Scheme, where we intend to run the portfolio for 3 to 4 years since the small cap cycle will last, and then we will wind down the fund and try to return the money to the investor. But more of it from the Vijay, who will be discussing about it. So that's all from my side. Thank you. Yeah, Vijay, over to you now.
Yeah, thank you, Prabhat. Yeah. So now, we have gone through a lot of data, and we have concluded that the small cap is at an attractive point, at an inflection point where it's presenting us the multi-decadal wealth creation opportunity. So just to set the context, so in last bull cycle, we reoriented the super value scheme, which is mainly the mid-cap bias scheme focused on mid-cap side, somewhere around November 2020. And from then, it has generated around 31.5% CAGR till May 2023 versus the index of 18% CAGR. And it was also ranked as the 5-star scheme on the PMS Bazaar platform and the first rank on the mid-cap category side. So with the opportunity that itself has presented in the small cap space, so this time we are betting on the small caps, similar to what we did in November 2020. This time it's a little bit different. We are betting on the different segment, the small cap, and along with the some small touch of micro cap. Now we will move into the underlying model of the multi-bagger framework and the future thesis. So first we will look at the multi-bagger framework. So this is the framework that we have built in the last 5 years at RH, and it has basically two legs. First is the growth part, second is the value part. So in the growth part, we look at the two things. So for any business to generate superior shareholders returns, two characteristics are very necessary when it comes to the growth. The first is the quantum of growth, which is what is the absolute amount of growth. So typically we look at the businesses which can generate 18 to 20% EPS growth or profit growth for next 4 to 5 years. So that will at least double the earnings in the 4 years period of time. And second part is the quality of growth. So in quality of growth, we focus on mainly the stability or durability of growth. So the growth should not fluctuate much. If it's coming 17 to 18%, so variation should not be like 1 year it's coming 10%, then it's another it's coming 25%. So those variations we don't like, because that is not a sign of a consistent business, and that is not sign of a moat or competitive advantages that business has built in. So we look for the businesses which have low variations, and we try to uncover the moats that are present in the business model, which helps or helps to increase the probability of success in that particular business. So that is about the growth part. Second is the value part, which is the base for the valuation of any business. So in any business that we pick, so we typically pick business which are trading at a discount to the sector leader as well as to the industry itself. So if I take example of the paint segment, the whole sector somewhere around trades around 45 to 50x PE, depending on the market fluctuations. And the leader like Asian Paint, it trades around 70x PE. But the portfolio company, or let's say the prospective company for the portfolio that we identify, so it should be around 25 to 30x PE, not more than that, because then we will also get the margin of safety from the valuation side. So it should be at a discount to the industry as well, and also at the sector leader itself. So this is how we combine the two legs, growth and value. So let's say if we are able to double our earnings in 4 to 5 years period of time, and the valuation which was 25x PE, if it goes up by let's say 50% to 40x PE or 45x PE, so 2 into 1.5, we will at least triple our money from a single bet. And this is how we pick any individual business in our portfolio. And in the super value aggressive as well, we identify around 25 to 30 businesses which have similar characteristics, but we also remain cognizant of the fact that this is a emerging leader space, so the chances of going wrong is also high. So let's say even if in case like 20% of the theses are not going as per our plan, and actually like resulting in the capital loss, and 80% of the theses are going as per plan, still we will be able to generate earnings growth, or let's say the total like potential of wealth is around 2.4x of the initial capital that we are targeting in. And this framework that we are discussing, we have already applied into the last bull cycle, but we were mainly applying it to the mid-cap names. So we will just discuss those things to put a perspective in clear mode. Yeah, Prabhu, please move to the next slide. Yeah. So these are the few themes that we identified and played in the last bull cycle. Of course, the data is for the research initiation and dropping of the research. So there can be some variation in the actual return side on the portfolio of our investors, but majority of the returns that in the research initiation and exit, those are captured over here. So if we take example of let's say the IRCTC that we played in the last bull cycle, so we entered it around 35x P, and we were expecting it earnings to at least double in the next 4 to 5 years period of time. But what we have seen, because of the monopoly nature and because of the discovery by the street itself, the valuation moved and earnings go discounted very early because of its strong business model and strong competitive advantages. And the P almost re-rated from 35x to 105, and earnings almost went double during that time. And it resulted into the sharp price run of around 6x before the split. So we entered around 35 XP and we were able to exit at 105. We also were able to witness the doubling of the earnings during that period, and it generated around 6 times return for us. Similarly, different companies like Neogen Chemicals, KEI, Dixon, APL Apollo Tubes, and GMM Pfaudler, these were all the last bull cycle peak, which did very well for us and helped us to generate around 31.5% CAGR in the last bull cycle. And some of the themes that we have identified over here are already out of our portfolio because the valuation has gone up. One or two themes are still present in our portfolio because of their reasonable valuation and a higher earnings growth potential for the next 3 to 4 years. But this time, as we are betting on the small cap, so we have also reoriented our sector outlook, that which sectors can be the winners for the upcoming bull cycle or even for the next decade. So for that, we did actually a macroeconomic global study that we will discuss, and it will also help to understand which sectors will do, or let's say create a maximum wealth in the upcoming decade. Yeah. Please move to the next slide, please. Yeah. So this is the study that we did on the global side. So basically, this chart captures the GDP per capita for a particular country, and also it captures the sector boom which happens on the once the GDP per capita booms from 3,000 to 5,000 to almost $8,500. And currently, if we look at the India, so India is around 2,350 GDP per capita dollar mark. And if we look at and we studied the journey of different countries who went to the 2,500 GDP per capita to 10,000 and eventually 20,000-30,000 in next 2-3 decades. So those countries witnessed basically three major booms. The first boom was the housing boom, like people saw or witnessed the higher earnings, or let's say higher income on their personal level. So they went for the house upgrades, or let's say the new houses. They shifted to the better places. So they saw a very building material kind of boom in the particular country. Second boom was the consumer discretionary boom, which was coming through the increased consumption from the fast food, or let's say the apparel side, or let's say the cars or automobile side. Also on the some of the electronic gadgets like refrigerator, personal computers, or AC side. And the third boom that we witnessed was the finance boom. So to fuel, or let's say to finance the first boom and the housing boom and the second of the consumer discretionary boom, people or citizens try to mix the own income plus the loan or the finance that they can get from the NBFC and banks, and they also witnessed a huge consumer finance boom. So these were the three booms that we clearly identified, and once we had these sectors, so we tried and we aimed to go deep into the particular sector and try to identify the multi-baggers or the potential emerging leaders which can benefit us to the create, or let's say ride the next bull cycle. So now once we have understood that these three booms are going to happen, then we applied this framework to identify the leaders or the emerging leaders for our super early aggressive portfolio. So in the last 7 months before launching this portfolio, so we met around 60 plus promoters, especially all from the segment like small cap and the micro cap side. All the new companies like which were recently listed or which was not discovered by the street earlier. So it helped us, it gave advantage in terms of the initial valuation, and also it also gave us the chance to ride the discovery premium. So these are the some of the sectors, or let's say the sub segment of the industry that we highlighted earlier, like paints, wires, and cables are coming from the building material side. Electronic retail, or let's say the fashion retail, is coming from the consumer discretionary side. Also, steel pipe is a part of building material. And on the consumer finance side, we typically like a NBFC versus a bank because of the servicing of the consumer level finance is relatively better on the NBFC side. So this six sub segments we have identified, and we picked around 6 or 7 different themes on individual side on the portfolio level. So just to take example of our portfolio company, which is a part of coming from the paint segment side. So it's currently trading around 35-40 XP depending on the current CMP, and the sector multiple is somewhere around 79 XP, which is on the trailing side, sector leader sector multiple. And on the forward side, it's around 50 to 60 XP. So discount is around 50%. So based on our internal calculation, we can see at least doubling of the earnings in the next 4 years. And also the multiple can expand substantially to the sector lead to at least the sector level, not if to the sector leader itself. So the opportunity is almost like initial capital outlay can almost become 4x if the thesis works out well. But we understand, like when we are dealing with this kind of emerging leaders, there is always chance of things going wrong. So that's why we have diversified our portfolio to around 25 to 30 different stocks. And we'll also look at some of the risk part, which protects us in case the thesis go wrong. So now we will move on to the risk side framework. Yeah. Yeah, please move to the next slide. Yeah. So in the risk framework, basically there are three types of risks that we mainly focus on when we are investing in any particular business. The first is the business risk. So we don't like businesses which are cyclical in nature or the earnings predictability is very low, because the fluctuation is very high. So the probability of being right also goes down. So we typically avoid such kind of businesses. Secondly, the valuation, we never pick a business which is trading at above its fair valuation, or trading at a very low margin of safety, essentially above its average multiple. So we never pick such businesses, which also gives us ample margin of safety in case our thesis goes wrong. And third is the corporate governance risk, which we are very strict about it. So we do a forensic check through the indiakanun.org as well, where we can uncover some of the financial frauds on the personal level, on the promoter side, as well as some pending litigations on the particular business side as well. And we don't invest with the companies which are like poor allocator of the capital. So we want the return on capital employed at least to be 20%. Also, there should be some dividend payout, and also the cash flow from the business should be also reasonable enough to justify the true earnings potential. Also, the promoter should be the very shareholder friendly, because we are investing to the public market. So we are essentially a minority shareholder. So they should be able to give proper disclosure. And we don't like promoters which are like hiding the stuffs and not accepting their mistakes honestly. So these three type of risks help us to increase our probability of being right, and also protects us in case the thesis don't go out as per our initial plan. And if we summarize the super value aggressive scheme that we have launched since April 2023. So it's a combination of around 25 to 30 high growth, high ROCE businesses available at a reasonable valuation. And we remain quite bullish and optimistic about their future prospects of delivering higher superior risk adjusted returns. But this time, the dynamics are different. In November 2020, like the dynamics was on the different for the mid cap side. But for the small cap this time, the size of opportunity is very small compared to the mid cap. And the second part, which is the valuation, as my colleague Prabhat highlighted, so that attractive valuation is very short-term phenomenon in the market. Once people become cognizant of this short-term valuation, so the inequilibrium or the discount tends to fade away with the time. So that's why we have decided it to open this scheme with the limited subscription period as well. And so that we can lock in the good valuation or the undervaluation of this particular businesses that we are picking up in the super value aggressive side, we can lock in and we can ride the next bull cycle along with the sizable momentum of the fair valuation reaching multiple. And we remain quite optimistic on the India growth story as well. And if anyone wants to be the part of this journey with us, please feel free to reach us. And with this, we will conclude this presentation. Thank you, ladies and gentlemen, for listening us patiently. Yeah. Over to you, Prabhu.
Yeah, thank you, sir. So we'll begin the Q&A session. So one of the investors is an existing investor. So they want to know whether they can top up with 50 lakhs in the super value aggressive. They already have a portfolio in super values. So is it okay to top up or move it completely? That is the question.
Yeah, for existing investors, so it's not a requirement to top up with 50 lakhs. So even with 10 lakhs, they can do a top up. And for a new investors, like who are opening the account for the first time with RHPMS, so as per the Sebi mandate, we have to start the account with at least minimum of 50 lakhs. But then again, 50 lakhs could be allocated to different schemes of the RHPMS. Right, so that opportunity is there with us, right? But for the existing customers, we don't need a top of 50 lakhs. We can start even with a 10 lakhs of top up. So basically, since it's a tactical opportunity and we'll be like winding the scheme as Vijay has highlighted, So as and when we'll feel that the scenario is not favorable for the small cap, so we'll wind down the scheme, we'll return the money to the investors, and then whatever the top up we have done in the super value aggressive, that can go back to again the more lower risk oriented schemes like IBL or flexi cap. So that way we have decided to go about it. And again, the subscription for this scheme, we have actually chosen to keep open for just next 2 months, right? So we started the scheme in March or April of this year, and we have decided to close down the scheme by July of this month, because we feel that most of the re-rating from bottom has already done, right? And going forward, we feel that July is a time when the earnings will be out, and because of the earnings, the companies, portfolio companies will see again the price growth, right? And again, there will be much more comfort around the macroeconomic environment, right? The rate cut scenario and all. So that would be a time ideally for us to close down the scheme and lock in the fund for the investors for next 4 or 5 years. So it will not be actual lock-in, because the SEBI doesn't allow for the lock-in to have in the mutual fund, so as to have in the PMS. But it will be will not be taking any money from the clients, and whatever the investment will be there, so it will be managed as and when which we receive by July of this year. Yeah, Prabhu.
Yeah, thank you, sir. So the next question is, how do we manage the risk for super value aggressive portfolio, or what is the drawdown expectations?
Yeah. So on the drawdown side, so normally 10 to 15% of the drawdown or fluctuation in the market can't be ruled out, right? Since it's a equity, we have seen multiple time happening. So earlier we used to see 15% kind of rally once 2 or 3 years. Now it's happening at least 2 or 3 times a year, right? 15% of the kind of rally in the market. So the fluctuation is quite anticipated for 10 to 15%, but the main wealth destroy happen when there is a volatility of more than 25% in the market, right? So this sort of scenario we have tried to curtail, mainly because we are just entering at the time when the valuations are actually cheap, and we feel that the tailwinds, the macroeconomic tailwinds are behind us. So in that way we are countering the macroeconomic fluctuation which will impact the portfolio. The other thing was on the stock specific side. So as Vijay has highlighted, we met close to 60 promoters in last 1 year, right? It was a dull market, no opportunity for us to make returns, but we were doing our work, right? And we met close to 60 small micro cap promoters in last 1 year, roughly 5 in a month. We have gone for multiple plant visits, and then we have decided to handpick around 20-25 companies in this portfolio. So we feel that we have done the sufficient check, right? It's very important to go and meet the promoter personally for a small or micro cap company, right? Because then only you can sure of the intentions of the promoter and their growth plans, right? So that's again one of the check we have done. And thirdly is the risk come from buying at a higher level, right? So that we are not going to let this happen in the super value aggressive scheme. So it's not a scheme like any other scheme which is out there. Like there are around 15-20 PMS schemes in the small cap category. How this scheme is different, because we are not going to take your money even when there will be a rally in the month of, let's say, November or December, right? We'll be curtailing the valuation threshold for the scheme by stopping the inflow in the month of July. So if there is a rally in the market and investors feel interested, but to protect their interest, we'll not be taking their money in the scheme. So we have the valuations comfort with us always. And also what we have seen, that the liquidity is a scenario for the small cap scheme, that large flows of money can't be absorbed easily in the small cap names. So we have tried to keep the portfolio size under 50 CR, right? And will not be raising huge sum of capital in the scheme. So will not be getting impacted by any liquidity environment also. So these are all the things we are trying to look at from different perspective to curtail the risk in the portfolio. I hope that answers to. Yeah.
Yeah, thank you, sir. So the next question is, do you also allocate to micro caps or SME listed stocks?
Yeah. So by SEBI definition, we have a definition of let's say 500 CR or 1000 CR as a micro cap. So we have around 40% of the holdings in the micro cap side. So, after SEBI rebalancing or SEBI rejig of the benchmark, so like most of the benchmarks, like most of the mid and multi-cap scheme, and in fact the small cap schemes are now benchmarked with BSE 500. And most of the fund managers have tried to shift their holding to be closer to the benchmark. So earlier, a few of the fund managers used to allocate in the small cap or micro cap names, even from this coming from the small cap side. Uh, but now that will again be they will be moving it closer to the BSE 500 mark, because they have to also hedge the performance. But since we'll be running this scheme on an absolute basis, right, and not on a like alignment with the benchmark. So we have actually allocated a large portion of this portfolio to the small cap names, and in fact we have around 2 to 3 names in the portfolio from the SME side as well, where we buy in lots, and we get some benefit by allocating to the to by buying lots for the investors. Because as an individual investor, let's say you have to do a top of 10 lakh and you have to buy SME name, so the SME stock itself come in a lot of 2 lakhs, right? So it will hugely look skew the portfolio bits in terms of small SME listed names. So that's why we have just the benefit of this investing in the platform or PMS platform is that you will get to add names from both the small SME side as well as the microcap side. Plus, since we are we have tied up with different promoters, and we are interacting with different brokers, and we are interacting directly with the promoters, so we can get the price at a very beneficial rate. So basically the pricing is somewhat more comfortable to us rather than buying directly from the open market. So those are the few positives that we have from the super value aggressive side. Yeah.
So more on the strategy side. So the participants are asking about the performance sharing fee and how does it work?
So basically, we have basically in the super really aggressive, we are basically like prioritizing the pure performance fee model only. So basically, we have a hybrid structure as well, but for the fact because it's a small caps oriented names, so we are typically promoting the profit sharing only model. So it's around the 20% of the profit that we make. So when on the annual basis, so let's say if the portfolio goes up by let's say 15-20%, so we'll be charging around 20% of the profit. And when the market is down the last year itself, so we will not be charging any fees, because in small cap the drawdowns are very painful, and when the market is already down, and it does not make sense to charge, at least for the small cap side. But the fees, the profit can be more when the market is going up disproportionately. So to keep our interest aligned, especially in the small cap side, which is quite different from the mid cap and large cap because of higher volatility. So we have internally decided to put it more of a profit sharing based model to align our interest with the investor due to higher fluctuation. So the one is the profit sharing option, pure one, and the other in the hybrid one. Yeah. So these are the two options available to any investor. Yeah.
Sir, one of the question is more on the broader side. So what is your take on the RBI's recent meeting?
Yeah, so RBI meeting, we are quite positive. If we look at the inflation data numbers, even for the developed economies or even the emerging economies, especially for India, so things are very under control, and the underlying factors which drive the inflation, basically the crude oil prices or the commodities, so they have almost collapsed 40-45% in the last 8-9 months. So inflation is no longer a problem. It's just question of when the growth will take priority over the inflation, and basically RBI will be forced to cut down the interest rate to promote the growth or increase the consumption. And we are quite optimistic on it, and also it will cause FIA basically to put more money into the small cap and mid cap side, which they had withdrawn in last 15 to 16 months of bear run. And just from the ground check, we are seeing a lot of FIs are coming to meet the Indian companies. In fact, in this first week of June itself, post earnings call, there were multiple conferences hosted by the large brokerage houses in the India, especially in the Mumbai region, where a lot of FIs have come and asked us shown significant interest in the small cap and in India as a overall in the equity exposure side as well. So we are expecting that the flows can be good based on the initial feedback from their side as well. And as a domestic investor, we get at least the advantage of putting money first before the FIs come and put the money. Because like the long-term investors like pension funds or the strategic buyers or the PE funds, so they never put money for, let's say, the 2-3 months or like 2-3 quarters. Let's say if they put money today and the market collapses by 10-15% because of some unforeseen situation, so they are not worried about that. Basically, those funds are there for at least a decade or 5 years period of time, like private equity. The pension fund can be there for at least 1-2 decade as well, because that's their ideal holding period. So those money plays a quite pivotal role in the journey of the small cap, and especially on the micro cap side that and small cap side that we are dealing with. So we are quite positive, like the momentum and dynamics are changing on the positive side from the negative side from the previous year. Yeah.
Sir, the next question is, so in the small cap and mid cap, is it advisable to put lump sum when the market is down, or is it always good to do SIP?
Yeah. So yeah, Vijay, please.
So basically, there are times like the decision to put lump sum or the SIP should be with the data driven. The decision should be data driven only. Like the valuation that we are witnessing today. So let's say the 2 months before, the valuation was very, very attractive, but still the valuations are attractive for the small cap and mid cap side. So if one wants to let's say join the journey of the mid cap and small cap, they can go for, let's say, the 2-3 max to max 2-3 kind of STP kind of thing or SIP kind of thing, like but not more than that. And the SIP for longer term can be good when the valuations are very high, so that you can diversify your entry point, but not when the valuations are already at the discount to their average level. So at that time, the ideal should be the lump sum of 3-4 tranches one can look to put and try to lock in the good valuation. Because what we have seen in the past as well, when the inflection point for the growth versus inflation, when growth wins, so there is a substantial consumption boom, like we witnessed in the one of the chart that we showcased, like the journey of GDP per capita almost going from 2,300 to 3,000 or the 4,000 for at least in next 4-5 years for India. So at that time, we will see a like sizable demand coming from there, and the opportunity of the wealth creation is quite big. And it's better to be a part of their wealth creation rather than try to time for the 10-15% correction. Because anyway, if a person is investing for the 4-5 years of horizon, so it does not make sense if we are targeting, let's say, 100% kind of absolute return. So it does not make sense for the 5-10% of correction that we can get. So their decision should be data driven, basically. Yeah.
Yeah, thank you, sir. So the last question is more on this multiple side that we've discussed. So what is the difference between current multiple and sector multiple, and yeah, that is more of the questions.
Yeah. So I think that was on the question of where Vijay were discussing about the future themes, right? So the current multiple is basically the multiple of the stock, right? And normally what we have seen is that the small caps trade at a multiple lower than the sector, or the other stocks, larger stocks in the same segment, mainly because these stocks are yet to be discovered, right? So these are sub 1,000, 2,000, 3,000 crore companies. So even these companies have a good track record of delivering consistent profit, good return ratios and all. Just because these companies small and there is no as such coverage by analyst, or there is no as such holding by other PMSs mutual funds. So these companies trade at a discount to their multiple. Now, what happens that over the time, when the companies got discovered by the street, so the multiple also start to rise, right? So they will keep on delivering the same sort of earnings they have delivered in the past, but just because of the discovery premium kicks in, and the multiple expands from, let's say, 17 to whatever the sector is trading at, right? For example, we just given an example of paints industry, right? So normally Berger Paints and other paint companies, like this industry, it is trading at, let's say, 60 or 65 P. The sector leader is Asian Paints, which is trading at, let's say, 90 P. So our company is a very undiscovered company. There is no as such brokerage note written by any brokers on that company, right? So it's hugely undiscovered company, even though it has a good 4-5 years of track record on the exchange. So that's why it's trading at a discount versus the peers, right? So it's trading at a multiple of close to 35. So what will happen that over the next few years, when the company will keep on delivering the profits and keep on expanding their reach, distribution network, and keep on delivering on the plans it has discussed with the analyst. So there will be an interest among the analyst community, and they will also start releasing reports. Then mutual funds will come and start taking exposure there. Other PMS will also get interested and start taking exposure in those in that company. So over the time, the multiple will expand from 35 to 70, which is the industry P. And then there will be a euphoria in the market. And then everybody will want to have that portfolio, that company in their own portfolio. And that will be a time when the multiple will shoots up, right? And it will I be in the range of 70, 80 or whatever. So that's how we see the entire journey of the company. That's part of our portfolio, that we buy the company when it's trading at a discount to their to the market, the sector valuation. And when it reaches and goes above and beyond the sector valuation, then it's our trigger to sell and exit from the company and look for the another story, right? So that's basically the difference between the current multiple of the company and what we think of is the future multiple that the company should command.